Markets often feel most dangerous when emotions run high and headlines grow loud. Fear pushes people to act quickly and abandon patience. Many investors confuse fear with risk and react without clarity. One calm approach shows how fear can be understood instead of followed. Fear is one of the strongest forces in financial markets. It spreads faster than facts and lingers longer than logic. When fear rises, people seek safety through action. That action often creates the very losses they fear. Most investors treat fear as a signal to escape. They sell quickly to avoid discomfort. Relief feels immediate but temporary. Long-term consequences are often ignored. Fear does not appear randomly in markets. It rises when uncertainty feels uncontrollable. Prices move sharply and confidence collapses. This emotional environment distorts judgment. The key difference between successful investors and the crowd is response. Some react to fear, while others study it. Reaction feels natural and urgent. Study feels slow and uncomfortable. Fear often peaks when information is incomplete. Headlines amplify worst-case scenarios. Negative narratives feel convincing. Rational assessment becomes difficult. Many people believe fear means danger is increasing. In reality, fear often means prices already reflect danger. By the time fear is obvious, losses may already be priced in. This misunderstanding leads to poor timing. Fear narrows focus and shortens time horizons. People stop thinking in years and start thinking in days. Short-term thinking increases mistakes. Long-term value becomes invisible. This is where patience becomes a competitive advantage. Patience allows distance from emotion. Distance restores perspective. Perspective enables better decisions. Fear also creates opportunity through mispricing. When many people sell simultaneously, prices fall faster than value changes. Emotion drives the move rather than fundamentals. That gap creates potential. Understanding this gap requires calm analysis. It requires separating business value from market emotion. Fear makes this separation difficult. Discipline makes it possible. Fear often convinces people that waiting is risky. Doing nothing feels irresponsible during panic. Action feels like control. Control is often an illusion. Markets reward those who can wait during discomfort. Waiting allows information to settle. It allows emotion to fade. Clarity often follows. Fear also reveals personal limits. It exposes how much uncertainty someone can tolerate. Many investors discover limits too late. Preparation helps define limits earlier. Preparation happens before fear appears. It involves understanding what you own. It involves knowing why you own it. Confidence comes from preparation, not prediction. Fear tests conviction more than intelligence. Knowledge without conviction collapses under pressure. Conviction without preparation becomes stubbornness. Balance is required. Fear often feels personal, but it is collective. Many people experience it at the same time. Collective emotion magnifies price movement. Individual calm becomes rare. This environment rewards those who can slow down. Slowing down creates space for reasoning. Reasoning challenges emotional narratives. Emotional narratives lose power when questioned. Fear also teaches humility. It reminds investors that uncertainty is constant. No outcome is guaranteed. Respect for uncertainty reduces arrogance. Some investors try to eliminate fear entirely. This goal is unrealistic. Fear is part of decision-making. The goal is to manage it. Managing fear starts with recognizing it. Naming emotion reduces its influence. Awareness creates distance. Distance restores choice. Fear can also be reframed as information. It signals where attention is focused. It reveals what the crowd is avoiding. Avoidance often hides opportunity. Opportunity created by fear does not feel comfortable. It rarely feels obvious or safe. Comfort usually appears after prices recover. By then, opportunity has passed. This is why emotional control matters more than speed. Speed amplifies mistakes under fear. Control slows decisions deliberately. Deliberate decisions age better. Fear also affects how people consume information. They seek confirmation of worry. Negative stories receive more attention. Balanced views are ignored. Reducing information intake can reduce fear. Fewer headlines create less urgency. Less urgency supports clearer thinking. Clarity supports better judgment. Fear-driven markets often feel chaotic. Volatility increases and predictions fail. Stability feels distant. This environment tests discipline. Discipline does not mean ignoring reality. It means responding thoughtfully rather than emotionally. Thoughtful responses require time. Time is rarely given during panic. Fear also magnifies short-term losses in the mind. Temporary declines feel permanent. Perspective shrinks under stress. Long-term context restores proportion. Investors who survive multiple cycles learn this lesson deeply. They recognize emotional patterns repeating. Familiarity reduces panic. Experience builds resilience. This approach reflects the mindset of Warren Buffett over many years. He treated fear as a condition to observe, not obey. Observation replaced reaction. That mindset shaped durable results. Turning fear into advantage does not mean seeking chaos. It means being prepared for it. Preparation allows calm action when others cannot. Calm action changes outcomes. In the end, fear will always exist in markets. It cannot be removed or predicted away. What matters is response. Response determines whether fear harms or helps.